In this video, we're breaking down why Cathie Wood just invested more than $61 million into 3 beaten-down tech growth stocks, while much of Wall Street has been running in the opposite direction. What does she see that the market doesn't? And more importantly, could these stocks become some of the biggest winners over the next decade once sentiment finally turns? Let's dive in. These are businesses that operate in industries that are reshaping how people manage money, move capital, and use technology in everyday life. Each one has built competitive advantages that could compound for years if management continues executing. Yet all 3 have been punished by the market, creating exactly the kind of setup Cathie Wood has built her investing career around. Let's start with SoFi Technologies, ticker symbol SOFI. One of the biggest mistakes investors make is assuming that every stock falling 30 or 40% deserves to fall. Sometimes that's true. Sometimes the business is fundamentally broken. But other times, the market becomes so focused on short-term concerns that it completely loses sight of where the company could be 5 or 10 years from now. That is where Cathie Wood tends to become interested. ARK Invest has never been known for buying companies after they've already become Wall Street favorites. Instead, Wood looks for innovative businesses that have temporarily fallen out of favor, but still have the potential to disrupt massive industries over the long run. That investment philosophy has led to plenty of criticism during difficult periods, but it has also made her one of the most closely watched growth investors in the market, and her latest move sends an interesting signal. Between June 29th and July 1st, ARK Innovation, ETF, purchased nearly 300,000 shares of SoFi Technologies. At the closing price on July 1st, that purchase was worth approximately $5.5 million. At first glance, $5.5 million may not sound extraordinary compared to some of ARK's larger investments, but here's why this purchase deserves attention. Just weeks earlier, ARK had actually reduced its position in SoFi. Now, instead of continuing to sell, Cathie Wood reversed course and started buying again. That naturally raises an important question. What changed? Did the business suddenly become dramatically better? Not really. Did the stock become significantly cheaper? Not necessarily. The answer may actually have more to do with how Wood evaluates long-term opportunities than what happened over a few weeks of trading. Cathie Wood has always said she invests based on where she believes innovation will create value over the next 5 to 10 years, not where earnings might come in next quarter. When she sees a high-conviction company trading well below what she believes its long-term potential is worth, market volatility often becomes an opportunity instead of a reason to panic. And SoFi fits that pattern almost perfectly. Despite improving many aspects of its business, SoFi's stock has had a difficult year. Shares remain down roughly 30% year-to-date, significantly underperforming the broader market. For many investors, that kind of decline is enough to move on. For Cathie Wood, it may simply represent a lower entry point. But before deciding whether that thesis makes sense, we need to understand what SoFi is actually becoming. Many people still think of SoFi as a student loan company. That description is years out of date. Today, SoFi is building something much larger. Management wants to create a digital financial ecosystem where customers can borrow money, save, invest, manage cash, and access a growing list of financial services without needing multiple financial institutions. Think about what that means from a business perspective. The average customer doesn't simply generate revenue once. Every additional financial product creates another opportunity to deepen the relationship. Someone who opens a savings account may later apply for a personal loan. A borrower may begin investing through the platform. An investor may eventually use additional financial products. Each new service makes the customer relationship more valuable while increasing the likelihood that the customer stays inside the ecosystem. That creates one of the most powerful growth engines any financial platform can build. Instead of constantly spending more money to acquire new customers, SoFi can continue generating additional revenue from the millions of members it already has. And those member numbers continue moving in the right direction. By the end of the first quarter, SoFi had grown to approximately 14.7 million members. Even more impressive, the company added more than 1 million new members in each of the previous 2 quarters and expects member growth of at least 30% this year. Those numbers matter because every new member represents future opportunities for cross-selling additional products. In fact, cross-selling has become one of SoFi's biggest competitive strengths. Management recently reported that the percentage of members using multiple products continued increasing, with the cross-buy rate improving from 40% to 43%. That might not sound dramatic, but over millions of customers, even small improvements can have a meaningful impact on revenue growth and customer lifetime value. This is exactly the kind of business model long-term investors love. Instead of relying on one product, the company continues expanding the number of ways it can generate revenue from each customer relationship. Another reason the business has become stronger over time is something many investors rarely discuss. Its banking charter. Obtaining a bank charter fundamentally changed how SoFi operates. Instead of relying heavily on expensive outside funding, the company can now use customer deposits to help fund lending activities. Lower funding costs improve efficiency while creating greater flexibility as interest rate environments change. That advantage may not grab headlines, but over the long run it can become a meaningful competitive edge. The company has also expanded into new lending categories, including products designed for small business owners. Will that transform the company overnight? Probably not. But every additional product makes the platform more valuable to existing members while opening new growth opportunities in the future. Then there is another area that likely caught Cathie Wood's attention: artificial intelligence. Innovation has always been at the center of ARK's investment philosophy, and SoFi is positioning itself to benefit from one of the biggest technology shifts happening today. Recently, the company introduced Composer by SoFi, an AI-powered investing platform designed to help investors transform investment ideas into automated strategies within minutes. Instead of requiring users to manually build complex investment systems, the platform allows them to test strategies using historical data before automatically executing them according to their selected rules. That has the potential to make sophisticated investing tools accessible to far more people. Artificial intelligence is beginning to reshape financial services, improving productivity, enhancing customer experiences, and helping companies deliver more personalized financial solutions. For SoFi, AI isn't just another feature. It could become another reason customers choose to remain inside the ecosystem while attracting entirely new users looking for smarter investing tools. Of course, no investment story is complete without discussing the challenges. One concern earlier this year involved the company's technology platform segment. Although overall first-quarter revenue grew an impressive 41% year-over-year, that particular segment experienced a revenue decline after a major client transitioned off the platform. The market reacted quickly. Whenever investors see weakness in one part of a growth business, fears often spread much faster than facts. But here's what many people overlooked: the core business continued expanding. Membership continued growing. Cross-selling continued improving. Revenue still exceeded expectations. Those are not the characteristics of a business in decline. They're the characteristics of a company working through temporary operational challenges while continuing to execute its broader strategy. Another encouraging signal came from inside the company itself. CEO Anthony Noto has continued buying shares with his own money through open market purchases. Most recently, he acquired additional shares that increased his direct ownership to nearly 12 million shares. Why does that matter? Because executives already receive stock compensation. When they voluntarily spend their own cash buying additional shares, they're expressing confidence that the market is undervaluing the business. Insider buying should never be the only reason to invest. But when management is buying while a respected growth investor like Cathie Wood is also adding shares, it certainly deserves attention. Now let's talk valuation. Some investors immediately dismiss SoFi because its valuation appears higher than traditional financial institutions. But comparing SoFi to an old-fashioned bank misses the point. This is a company combining lending, financial technology, digital banking, investing tools, subscription services, and technology infrastructure into one expanding ecosystem. Its faster-growing business segments naturally deserve different valuation expectations than mature financial institutions with limited growth prospects. Analysts also expect earnings to continue growing rapidly over the next several years. If those projections materialize, today's valuation could look much more reasonable in hindsight than it appears today. That doesn't mean the stock is risk-free. Far from it. Execution still matters. Competition remains intense. Economic conditions could affect lending demand. Growth will almost certainly slow eventually as the company becomes larger. Those are real risks every investor should consider. But investing is never about finding companies with zero risk. It's about determining whether the market is overestimating those risks relative to the company's long-term opportunity. That is ultimately what Cathie Wood appears to be betting on. She isn't buying SoFi because the next quarter is guaranteed to be perfect. She's buying because she believes the market is focusing too heavily on today's concerns while underestimating where this business could be several years from now. Whether she's ultimately right remains to be seen. But if SoFi continues expanding its ecosystem, growing its membership base, increasing cross-selling, integrating artificial intelligence into more services, and improving profitability, today's share price could eventually look like an attractive long-term entry point. And that possibility is exactly why this purchase deserves investors' attention. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Cathie Wood's next purchase tells us something even bigger about where she believes the financial system itself is heading. The second company is Circle Internet Group, ticker symbol CRCL. Few companies have generated as much excitement this year as Circle. After its public debut, the stock surged as investors rushed to gain exposure to what many viewed as one of the most important businesses emerging from the digital asset economy. But just as quickly as enthusiasm arrived, reality set in. Profit-taking accelerated. The stock experienced a steep pullback. Many investors who had chased the rally suddenly found themselves wondering if they had made a mistake. That is precisely when Cathie Wood decided to buy. Across 3 ARK exchange-traded funds, her firm purchased more than 287,000 shares, representing an investment of roughly $17.8 million. Instead of fearing the decline, she treated it as an opportunity. That should immediately make investors ask one question: why would an experienced growth investor increase her position while the market was rushing for the exits? The answer starts with understanding what Circle actually represents. Many people think Circle is simply another cryptocurrency company. I believe that's far too narrow. Circle is really building financial infrastructure. Its mission is to make moving money across the internet as seamless as sending an email. For decades, payments have largely depended on systems designed long before today's digital economy existed. Cross-border transactions can still take days, settlement costs remain high, businesses continue dealing with unnecessary friction. Circle wants to change that. If the financial system continues moving toward faster, internet-native payments, companies providing that infrastructure could become enormously valuable. That is the long-term opportunity Cathie Wood appears to be focused on. Notice something important about her investing style. She rarely buys companies because she believes next quarter's earnings will surprise investors. She buys companies she believes could reshape entire industries over the next decade. Circle fits squarely into that investment framework. Of course, none of that prevented the stock from falling sharply. Over the past month, shares declined dramatically as investors locked in profits following the company's explosive run higher. Part of that selling pressure came after changes to major market indexes resulted in passive investment funds adjusting their holdings. Events like these often have very little to do with the underlying quality of the business itself. Instead, they create temporary supply and demand imbalances that can push prices lower regardless of fundamentals. Long-term investors often pay close attention during periods like this. They know the market sometimes creates opportunities when technical selling overwhelms fundamental analysis. That may be exactly how ARK viewed the situation. Rather than focusing on why the stock had fallen over the previous several weeks, Cathie Wood appears to have focused on where the business could be several years from now. That is a completely different mindset. One of Circle's biggest competitive strengths is trust. In financial services, trust is incredibly difficult to build and remarkably easy to lose. Businesses handling billions of dollars in digital transactions must convince customers, institutions, and regulators that their systems are reliable. That isn't something competitors can replicate overnight. As adoption of digital payments continues expanding, companies that establish themselves as trusted infrastructure providers could benefit from powerful network effects. The more businesses using the platform, the more valuable that platform becomes. Network effects have created some of the world's most valuable companies across multiple industries. Circle has the potential to benefit from a similar dynamic if adoption continues increasing over time. Another encouraging development involves the company's efforts to strengthen relationships with institutional clients. Expanding access for larger financial organizations helps reinforce Circle's position within the evolving digital payments ecosystem. Institutional adoption is particularly important because large organizations typically require high levels of security, compliance, and operational reliability before integrating new financial technology. Winning those relationships can create long-lasting customer connections that are difficult for competitors to displace. That doesn't mean Circle's future will be easy. Far from it. Competition remains intense. The digital payments landscape continues evolving rapidly. Technology changes quickly. Regulatory environments continue developing. Investor expectations also remain extremely high. All of those factors create uncertainty, and uncertainty often produces volatility. We've already seen how quickly sentiment can change. Only weeks after investors were celebrating Circle's rapid ascent, many became equally convinced that the rally had gone too far. Markets have always behaved this way. Optimism often overshoots. Pessimism often overshoots too. Successful long-term investors try to avoid getting caught in either extreme. Instead, they focus on whether the underlying business is becoming stronger over time. That appears to be exactly what Cathie Wood is doing. Rather than chasing momentum, she's buying after weakness. Rather than reacting emotionally to falling prices, she's asking whether the company's long-term opportunity has materially changed. If the answer is no, then lower prices may actually improve future return potential. That's a very different way of thinking than most market participants. It's also worth remembering that disruptive companies rarely travel in straight lines. Even businesses that eventually become enormous success stories often experience dramatic corrections along the way. Those corrections can be uncomfortable. They can test investor conviction, but they also create opportunities for investors willing to focus beyond the next few quarters. The real investment case for Circle isn't about whether shares recover next month. It's about whether digital financial infrastructure continues becoming more important over the next decade. If businesses increasingly move toward faster, programmable, internet-based financial systems, companies providing that infrastructure could occupy an increasingly valuable position within the global economy. That is the long-term thesis. Naturally, valuation remains an important consideration. Like many innovative growth companies, Circle trades on future expectations as much as current financial performance. That means execution will matter enormously. Management must continue expanding adoption, strengthening customer relationships, and demonstrating that its platform can scale efficiently while maintaining trust. If execution disappoints, investors could reassess those expectations quickly. But if management delivers, today's volatility may eventually look insignificant compared to the company's long-term opportunity. That's exactly why this purchase stands out. Cathie Wood didn't buy after months of steady gains. She bought after fear returned to the market. Whether that proves to be another successful investment remains uncertain, but her decision reinforces a consistent message we've seen throughout her investing career. Innovation rarely follows a straight line. Some of the biggest long-term opportunities emerge precisely when short-term sentiment becomes overwhelmingly negative. Circle may still experience significant volatility in the months ahead. Growth investing is never smooth, but if the business continues strengthening its position within the future of digital finance, today's pullback could eventually be remembered as another temporary chapter in a much larger story. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third company is Tesla, ticker symbol TSLA. Out of all three purchases, this one carried the largest price tag by a wide margin. ARK Invest purchased approximately 96,935 shares, representing an investment of roughly $38.1 million. The timing made the move even more interesting. Tesla had just reported second-quarter vehicle deliveries that comfortably exceeded market expectations. The company delivered more than 480,000 vehicles, beating analyst estimates by a significant margin and reversing its streak of annual delivery declines. Normally, a report like that would send shares higher. Instead, the stock fell sharply. For many investors, that kind of price action doesn't make sense. How can a company beat expectations and still see its stock decline? The answer reminds us of one of the most important lessons in investing. Stocks don't move based only on whether results are good or bad. They move based on expectations. Sometimes investors have already priced in good news before it arrives. Other times, broader concerns outweigh positive developments. And sometimes the market simply becomes emotional in the short term. Cathie Wood clearly wasn't discouraged. Instead of viewing the sell-off as a warning sign, she viewed it as another opportunity to increase her position. That shouldn't surprise anyone who has followed her investment philosophy. Tesla has long been one of ARK Invest's highest conviction holdings, but this latest purchase wasn't simply about staying loyal to an old favorite. It reflected something much deeper. Cathie Wood has never viewed Tesla as just another automobile manufacturer. She views it as an artificial intelligence company. That distinction changes everything. If someone believes Tesla's future depends only on selling more electric vehicles, then today's valuation may seem difficult to justify. But if someone believes Tesla is building one of the world's leading real-world artificial intelligence platforms, the investment case becomes much larger. That is the lens through which Cathie Wood evaluates the company. She has repeatedly argued that autonomous driving represents one of the biggest technological transformations of our generation. In her view, Tesla's future value depends far more on software, artificial intelligence, and autonomous transportation than on traditional vehicle manufacturing. Whether you agree with that thesis or not, it's important to understand why she continues buying. She isn't investing based on next year's vehicle sales. She's investing based on where she believes transportation could be heading over the next decade, and that conviction has remained remarkably consistent. Even during periods when Tesla experienced significant corrections, ARK has repeatedly added to its position rather than reducing exposure. That's exactly what happened again here. Of course, Tesla still faces meaningful challenges. The company has experienced slowing growth in some markets. Competitive pressures continue increasing. Public perception has also been influenced by controversies surrounding Chief Executive Officer Elon Musk. Those issues have contributed to increased volatility throughout the year. Investors have also been adjusting to the loss of certain government incentives that previously supported electric vehicle demand. Taken together, those concerns have weighed heavily on investor sentiment. But despite all those headwinds, Tesla continues demonstrating something many companies struggle to achieve: operational resilience. Even while navigating a difficult environment, the company delivered far more vehicles than analysts expected during the second quarter. That tells us management is still executing at a high level despite external challenges. It also suggests the underlying business may be stronger than the market currently believes. Then there is the broader technology story. Tesla collects enormous amounts of real-world driving data every single day. That data becomes increasingly valuable as artificial intelligence systems continue improving. Unlike many companies building AI primarily in digital environments, Tesla gathers information from millions of real-world miles driven under countless road conditions. That creates an enormous learning opportunity for autonomous driving systems. If autonomous transportation becomes mainstream over the coming decade, companies with years of real-world driving experience could possess a significant competitive advantage. That is one reason Cathie Wood remains extraordinarily optimistic about Tesla's long-term prospects. She has publicly projected that Tesla could eventually reach a valuation far above where it trades today. Her reasoning isn't centered on electric vehicle sales alone. Instead, she believes autonomous transportation could ultimately become the company's largest value driver. Whether that prediction proves correct remains one of the biggest debates on Wall Street. Some investors believe autonomous technology will transform transportation much faster than expected. Others believe widespread adoption will take considerably longer. No one knows exactly how that timeline will unfold, but one thing is clear. If Tesla successfully commercializes autonomous transportation at scale, the company could evolve into something much larger than today's automobile manufacturer. That possibility explains why Cathie Wood continues treating periods of market weakness as buying opportunities rather than reasons to abandon her investment thesis. Naturally, investors should also recognize the risks. Tesla remains one of the market's most volatile large capitalization companies. Its valuation assumes continued innovation and strong execution. Any delays in new technologies, increased competition, or slower than expected adoption could place pressure on future returns. Those risks are real. At the same time, some of the market's greatest long-term winners have often looked expensive and controversial while they were building entirely new industries. That's why investing requires looking beyond today's headlines. The market often focuses on what happened yesterday. Long-term investors try to focus on what the business could become tomorrow. When you step back and look at all three purchases together, a clear pattern begins to emerge. Cathie Wood isn't simply buying companies whose share prices have declined. She's buying businesses that she believes are building the future. SoFi is working to redefine digital banking through an expanding financial ecosystem. Circle is helping build infrastructure for the next generation of digital payments. Tesla continues pushing the boundaries of artificial intelligence and autonomous transportation. These businesses operate in different industries, but they share one common characteristic. Each one has experienced significant market volatility despite pursuing enormous long-term opportunities. That is exactly where Cathie Wood has consistently looked for investment opportunities throughout her career. Will every one of these investments succeed? Probably not. Even the world's best investors are wrong from time to time. But history has repeatedly shown that transformative companies often experience their greatest skepticism long before they achieve their greatest success. The challenge for investors is deciding whether today's concerns are temporary obstacles or permanent problems. That is where independent research becomes incredibly important. Rather than blindly following any investor, including Cathie Wood, use their moves as a starting point for your own analysis. Study the business, understand the risks, evaluate management, decide whether the long-term opportunity aligns with your own investment strategy. That approach gives you the best chance of making informed decisions regardless of what the market does next. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, Join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage over the next 10 years, and which one do you think Cathie Wood got most right? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.